What if the biggest threat to the U.S. economy in 2026 isn't inflation, isn't the stock market, but the national debt itself? The United States is carrying more debt than at any other time in its history. Federal debt has crossed historic levels, and interest payments alone are becoming one of the largest line items in the federal budget. The deeper question investors are quietly asking is this: are we watching a manageable fiscal expansion or the early stages of a debt bubble? To understand the concern, we have to understand scale. The U.S. national debt has grown rapidly over the past 2 decades due to wars, tax cuts, stimulus packages, financial crises, and pandemic spending. During periods of low interest rates, this borrowing didn't seem urgent. Debt was cheap. Servicing costs were manageable. But the environment has changed. The Federal Reserve raised interest rates aggressively in recent years to combat inflation. Higher rates mean new government borrowing costs more. As old debt matures, it must be refinanced at higher yields. This is where the pressure builds. When interest payments grow faster than tax revenues, governments face tough choices. Raise taxes, cut spending, borrow more. Borrowing more to pay interest is where concerns emerge. Here's why markets are paying attention. U.S. Treasury bonds are considered the safest asset in the world. They are the foundation of the global financial system. Banks, pension funds, and foreign governments hold trillions in treasuries. But if debt continues to expand while deficits remain high, supply increases dramatically. To attract buyers, yields may need to rise further. Rising yields increase interest costs even more, creating a feedback loop. This isn't an overnight collapse scenario. It's a slow structural stress. The United States benefits from something no other country has: the dollar's reserve currency status. Global trade is largely conducted in U.S. dollars. Foreign central banks hold dollar reserves. That creates constant demand for Treasury securities. However, geopolitical shifts are gradually testing that dominance. Some countries are exploring alternative settlement systems. While the dollar remains dominant, diversification trends raise long-term questions. Another risk factor is demographics. As the population ages, entitlement spending, Social Security, and Medicare increases. These programs are major drivers of future deficits. Without reform, debt projections rise significantly over the next decade. So is this a bubble? A bubble typically involves rapid price expansion detached from fundamentals, followed by a sharp correction. In sovereign debt, the correction doesn't look like a stock crash. It looks like rising yields, currency weakness, and fiscal tightening. The key difference with the United States is scale and credibility. Investors trust U.S. institutions. They trust the rule of law. They trust liquidity, depth. That trust acts as a stabilizer. But trust is not infinite. Credit rating agencies have already signaled concerns in recent years by adjusting outlooks. While the U.S. remains highly rated, fiscal discipline discussions are growing louder. If interest payments consume a larger share of the federal budget than defense or infrastructure, policymakers will face intense pressure. The immediate risk isn't default. The realistic risk is slower growth. High debt levels can crowd out private investment. If government borrowing absorbs available capital, private businesses may face higher borrowing costs. That slows innovation and expansion. Another subtle risk is inflation temptation. Historically, heavily indebted governments sometimes allow inflation to erode real debt burdens. While no central bank openly targets this strategy, markets remain sensitive to any signs of fiscal dominance where monetary policy becomes influenced by government financing needs. Right now, the U.S. is walking a narrow path. Debt is high. Interest rates are elevated. Global competition is intensifying. Spending pressures are rising. But the system hasn't cracked. The bond market remains functional. Treasury auctions are still the dollar remains strong relative to alternatives. That's why some economists argue this is not a bubble, it's a manageable long-term imbalance. The real issue may not be collapse. It may be sustainability, and sustainability depends on growth. If economic growth outpaces debt growth, the burden stabilizes. If growth slows while debt accelerates, pressure compounds. So the real question isn't whether the debt bubble bursts tomorrow, it's whether long-term fiscal math still works. Now imagine a scenario where debt concerns escalate. What would a burst actually look like? It likely wouldn't resemble the 2008 financial crisis. Banks are better capitalized today. Regulatory oversight is stronger. Household leverage is not as extreme. Instead, stress would appear gradually. First sign: sustained rise in Treasury yields. If investors demand higher returns to compensate for fiscal risk, borrowing costs surge. Mortgage rates climb. Corporate bond yields rise. Equity valuations compress. Higher yields ripple through every financial asset class. Second sign: Dollar volatility. If global investors begin diversifying away from U.S. assets, the dollar could weaken. A weaker dollar can boost exports, but it can also increase import costs, reigniting inflation. Third sign. Political standoff. Debt ceiling debates could intensify market uncertainty, even if default remains unlikely. Political dysfunction can shake investor confidence temporarily. Fourth sign. Fiscal tightening. 2. Regain credibility. Lawmakers may implement spending cuts or tax increases. Both actions can slow economic growth in the short term, but here's the critical reality. The United States is not a typical emerging market vulnerable to sudden debt collapse. It issues debt in its own currency. It controls its monetary policy. And global capital markets remain deeply intertwined with U.S. finance. That structural advantage makes an outright burst unlikely in the near term. However, long-term risks accumulate quietly. If interest costs approach unsustainable proportions of revenue, future policymakers may face difficult reforms. Markets react not only to current numbers, but to projected trajectories. Investors today are focused on three metrics: debt to GDP ratio, interest expense growth, long-term treasury demand. If GDP growth slows below borrowing growth for extended periods, sustainability weakens. This is why economic growth is central to the debt debate. Innovation, productivity gains, and labor participation can improve fiscal math dramatically. Stagnation magnifies risk. Some analysts argue that moderate inflation over time can help reduce real debt burdens as long as rates remain controlled. Others warn that debt remains manageable. If confidence erodes, volatility accelerates. So is the U.S. debt bubble about to burst. In the short term, unlikely. In the long term, sustainability depends on policy, discipline, and economic strength. The danger isn't sudden collapse. The danger is complacency. Debt doesn't explode overnight in advanced economies. It constrains, but for taxpayers, businesses, and future generations, the real story isn't fear, it's fiscal trajectory. And that trajectory is still being written.